You are listening to Keystone's Stock Talk Show, episode 288.
If this is your first time listening, then thanks for stopping by. This podcast is produced every week for your enjoyment, and show notes are found at www.keystocks.com. Come back often, and feel free to add the podcast to your favorite RSS feed or on iTunes. You can also follow us on Twitter at Keystocks and on Facebook, and keep submitting your stocks via the usual social channels or at our website, keystocks.com, for our Your Stock Our Take segment. And we just might review your stock in an upcoming show and let you know if it is a buy, sell, or hold.
It's great to chat with you again this week. I am back from the Money Show in beautiful Las Vegas with a story to tell. In our Your Stock Our Take segment, I will begin with a viewer question on Osisko Gold Royalty Limited, symbol OR on the TSX, an intermediate precious metal royalty company which holds a North American-focused portfolio of over 185 royalties, streams, and precious metal offtakes, including 20 producing assets. With the price of gold at record prices, the viewer asks if now is a good time to buy this gold royalty company. Aaron answers a viewer question on Advanced Micro Devices, symbol AMD on the NASDAQ, a leading semiconductor company specializing in the development of high-performance computing, graphics, and visualization technologies for consumer and enterprise markets. The stock is down 38% over the past year. Aaron lets you know why and if it is an opportunity. In our final Your Stock Our Take of the week, Brennan tackles a viewer question on Well Health Technologies, symbol WELL on the TSX, a omni-channel healthcare services company, including primary care and allied healthcare clinic operations. Well is up 62% over the past year. Brennan will let you know if the jump is justified. In our Star and Dog segment, Brett's Star of the Week is Celcius Holdings, symbol CELH on the NASDAQ. It's a global beverage company and maker of energy drink Celcius, a zero sugar alternative to traditional energy drinks. The share price shot up 35% last Friday, and Brett will let you know why. His dog of the week is TFI International, symbol TFII on the TSX and the New York Stock Exchange, a North American leader in the transportation and logistics industry. The company operates across Canada and the US and into Mexico, serving less than a truckload, and logistic segments. TFI was down 30% over the past week after it reported lower than expected earnings. All right, let's get into the show. I'm going to welcome my co-host, Mr. Aaron Dunn, the Killer Bees, Brett and Brennan. How are you guys doing?
We're doing great. We're doing great. What's this, though, that you have a story to tell?
Oh, just my trip back from Vegas. I was supposed to, I signed up for the early flight to come out. I got up at about 4:30, I think Thursday morning in Vegas, which is always a challenge, and made it to the airport, but knowing that I would get on that flight because, nothing usually happens to those morning flights. But as I got in, they said the flight was delayed by 20 minutes. And then I subsequently got about 6 of those notifications for 20-minute delays. And then we got a 2-hour delay, and I was nearing 2:30, 3 o'clock, pretty weary at that point. And then we got a absolute cancellation. And apparently there was some weather back east. I'm sure many viewers are aware of that. And there was an incident. The plane flipped over at the airport. So they literally couldn't get any other planes out here. We couldn't get on any other plane at that point unless a couple of us had connections, and 2 or 3 people got transferred onto, but those are people that had to be somewhere else. I was just going direct to Vancouver, and I spent another night in Vegas, and then I couldn't get out on a flight until about 4:40, which I arrived to the airport in time and everything, and then I got a 20-minute delay. Then I got another 20-minute delay. Then I got a 2-hour delay, and I think I finally got home at about midnight on Friday. So Vegas to Vancouver is like under a 3-hour flight. It should not take that long. I know there was some unforeseen conditions, but this was all really actual mechanical issues with the plane that we were getting on. So yes, there was a delay getting a plane there the second day, but it was all really just mechanical issues. And Air Canada doesn't give you a lot of information. They're texting you out, the delays as you go. But when they finally canceled it, no text on where your luggage is, no text on they gave us $15 vouchers for food. That was great. That was amazing. I mean, we spent that on a chocolate bar in Vegas probably. But anyways, yeah, so we didn't have all that. I had to track over. I went to the Air Canada booth. There's 150 people in the lineup. Thankfully, Porter Air was right next to them with nobody in the lineup. I went around and I said, do you know where we're supposed to pick up our baggage for a flight? And one of them went back, tapped the Air Canada transport person on the back. They said 24. I went to 24. There was about 15 bags just laying there, and mine was one of them, and they were taking them in. And I said, you should probably, put that out on the app, which tracks our baggage, and, tweet that out. Well, we made an announcement. I'm like, well, we were waiting there for 8 hours. Do you think that everybody was just standing there right for that announcement? At that time, people went to eat. But anyways, it wasn't his fault, Air Canada's fault overall. But anyways, and not being able to get you on a flight the next day till 4 or 5 o'clock is really kind of trying at that point. And then, just having that delayed again for another 4 hours is awesome. So yeah, they'll probably offer me a 10% discount on my next flight though. So that's huge, right? I mean, that did happen to my family. We were delayed.
When I said Ryan was never getting home, we were going to be in Vegas for weeks.
Midday on Friday, I was just called home, and I'm just going to stay until the next conference, and we're just going to hang out here, right?
Yeah, I did talk to you. I guess that would have been Thursday evening, and you said that it was kind of cool to watch the Four Nations Championship game against Canada against USA.
Okay, so I would say I wanted to watch that at home with my dad, my family, my daughter. That would have been awesome. But I did watch it in a Vegas hotel. I watched the first 2 periods in the hotel because every time I go to Vegas, I think, I'm like, can you put on the Canucks game? And they're like, what's a Canucks game? Right. So anyways, I go and I go downstairs and I'm thinking I'm going to have to watch this in my room, but I'm starved. I go down to get something to eat, and every screen, even the ones behind the slot machines, all of this, and the massive screens, and people are glued to it watching this, US people watching hockey is weird, right? And they were all into it, and they're asking, I sit down and they're asking questions what do these shots mean? It says shot totals, and I'm talking to them, telling them. And then Canada, we go to overtime, Canada scores, and I'm screaming, and I realize there's nobody screaming. Everybody's looking at me, and the first thing I say after I'm yelling F yeah is sorry, right? And I'm like, that's pretty Canadian, right? I'm so sorry. I'm apologizing for cheering, right? And then a couple guys across the room are yelling and screaming too, and we go hug. And I don't know, I think we were getting a stink eye the whole time, but it was cool that they were engaged, right? They were really into it. But that was cool. And I took a picture of the room, and there was it was a lot of obviously Americans in that room. A guy told me later that he was in a room of 75% Canadians. I was not in that room. No, there was 80 something percent US. Yeah. But it was cool to see them into it. They did a really good job in the Four Nations. And, they thought they were kind of talking about it down there like it was the All-Star game, or version of our All-Star game. We didn't do it. So they loved it because the All-Star games in most sports are just non-competitive. People are just walking around trying not to get injured, right? But this was they had that game where the first game, Canada and the US, where they fought 3 fights within the first 5 seconds of the game. And that was just... people punching people in the face. Everybody in the US was like, this is the greatest thing ever. And so that made it I think without that, nobody's watching, but there was face punching. So they watched. It's cool. Oh, you're muted, Aaron.
Some people saying it symbolizes our evolving relationship with the United States.
Well, yeah. And so there was that too. So I said to several people, so you want us to be our 51st state, right? I was saying that down there. I swear, only on half of them did it register. Most are what do you even mean? And then some are oh yeah, I get it. Ha, ha, ha. I mean, I don't think it's front of consciousness.
A lot of them didn't even know.
That was the thing. A lot didn't even know. And then they would kind of search their brains and what is this guy talking about? And they're oh, Trump might have said something about that, right? It's for us, it's boom, it's right there. For them, it's what? Who? What, Canada? What is this? Oh, you guys are all. bunch of hosers, eh? That's about all they, honestly. It's so funny. Anyways, there wasn't any animosity or anything like that. You didn't feel like that. Unless people were throwing stuff at me when I walked away, probably more animosity, just that I was cheering.
I'm
when
glad they
Canada
weren't
scored.
angry at you for threatening to annex us.
I know.
I'm joking. It's not them who's said that. But anyways,
no.
Neither here nor there.
Yeah, so it was interesting. We'll see. We're going down, I think, me and Brett and Brennan next month, right, to California. And I wouldn't expect anything, but we will say to them.
And we're all on the same flight too, so I might need to get a different one than you.
We're not on Air Canada this time, are we?
I don't think so.
I think it's WestJet. Yeah, it's WestJet.
But we could.
I seem to think Ryan's luck with air flying is airplanes is just not the greatest. So
but I'm on a lot of them. We're on a lot of them, right? So, there's a lot of crap though.
It's bound to happen.
The one that I had with my family, where it was supposed to go to New York to direct flight, and I spent 2 days in Montreal. And we spent 6 hours on the tarmac, which is not even supposed to be allowed. So I don't even understand that. And then there was an earthquake the second day in New York, where there's never an earthquake. As we were going to take off, it's like, oh, we got to go back because they got to check the runways. It's like, there was an earthquake in Vancouver or BC this weekend. And that was on the day that I was flying out. I'm like, oh my God, they're going to have to check YVR's runways. I'm here forever. All right. Anyways. Okay, we're good. Let's actually talk about stocks. Nobody cares about any of this. Okay, there was a poll question, right?
Yeah, we'll go into the poll question.
Magnificent Seven.
Yeah. Back to the States with this one. The Magnificent Seven drove the index returns in 2023, 2024. You'd have to be living under probably multiple rocks to really be avoiding it. But in 2025, only Meta has been outperforming the S&P 500 year to date. So the question is, how will the Magnificent Seven perform compared to the S&P 500 in 2025? 18% of our viewers think it will outperform. 47% say roughly in line, and the 35% say it will underperform the S&P 500, which I think that's a pretty expected result. I'm not overly shocked that there's more people expecting underperforming than overperforming, especially with how I framed the question. But overall, just we've been seeing more and more, and we've really rambled on it quite a few times, just the valuations, especially in those top echelon of U.S. stocks, even past the Magnificent Seven. Your Costco's of the world is the one I keep pulling out, is how expensive that company's got. Great company, but very expensive. And you're really, is it the time where it's actually going to pull back now in 2025, or are we going to keep seeing these high valuations going forward?
Yeah, I don't know your guys' thoughts. What did you vote on that, Brandon?
I voted underperform. I just think that after the strong year last year, I think that, higher valuations as well, of course. But I was looking at an article and just from Bank of America Securities, they were just saying that more stocks are outperforming the S&P 500 at the beginning of this year, at least. Where, the last 2 years, we had significant underperformance from, most of the stocks on the S&P 500. So I can put up this graph here as well. I'll have Brett show that graph, but this is just from the article that I read there, just showing that, the median is typically, 48% of stocks outperforming the S&P 500. You can see the last couple of years, most have been, underperforming essentially the S&P 500 as a whole. And again, given the strength of, the Magnificent Seven, for sure. Yeah,
and I think in some high quality, and we've talked about this at our webinars for the past couple of years, in the high quality small cap names, that was a great time to buy those. You had underperformance there, like some babies thrown out with the bathwater. And in 2023, 2024, you were able to buy them at a discount. And it's not like the index outperformed over the past year, but you look at some really high quality names. Some of the companies that we've recommended had tremendous gains over that period, like the Vital Hubs and the Ciphers of the world that are up like 250% over the past 18 months. You were able to find a segment in small caps that was depressed and buy kind of the pick of the litter at better prices. And they have certainly outperformed. And now you're seeing some of those, the kind of stark outperformance of the Magnificent Seven. Maybe that is ending a little bit. But I mean, there's some great companies, obviously, in that Magnificent Seven. So I would have said roughly in line, but
the interesting part about breaking that down too is I think Tesla, when I was looking at this on Friday, was down about roughly 16% year to date. Then Meta was up about 16 or 17% as well. And then the other five were all down like 2 to 5%, something like that, relatively low decline. So it's kind of interesting how we see one outperformer, one underperformer, then the rest kind of grouped up.
And I think that's at that 2% or whatever, it could flip.
Yeah, it could. Exactly. Like by the time you're watching this, that could be noticeably different. And that's the thing is, if the rest stay flat and we see Tesla, for example, really decline in the year, it might even, if you are looking at that as a group, be a low performer, even if the rest do in line. Yeah. If we are thinking of it like an ETF, which there are Magnificent 7 ETFs, it is an investable product.
Yep, for sure. All right, I guess we should get into the meat of the show. I can just start sharing my screen. Okay, I'm going to start with a viewer question on Osisko Gold Royalties Limited, symbol OR on the TSX, trades around 25.50, market cap of 4.95 billion, just under 1% yield. What do they do? They're an intermediate precious metal royalty company, which holds a North American focused portfolio of over 185 royalties, streams, and precious metal offtakes, including 20 producing assets. Osisko's portfolio is anchored by its cornerstone asset, a 3 to 5% net smelter return royalty on the Canadian Malartic Complex, one of Canada's largest gold operations. So the shares have performed well over the past year, up 39.79%. Having said that, gold it's have done better. It's actually underperformed gold, the shares of Osisko. Gold itself was up 45.35% over the past year. You can see gold here shown in blue and Osisko in yellow. Now, if we look over the past 5 years, Osisko has performed quite well, up 140.71%. This actually substantially outpaced the price of gold over that same time frame. Gold was up just around 89.19% over that 5-year time frame. Finally, if we look all time on Osisko here, you can see this is back to when it listed in June around 2014, the $15 to $16 range. The stock is up just 67% in nearly 11 years, which is really not the most stellar return. All right, let's look at the 2024 financial highlights from Osisko. Gold production and gold equivalent ounces, or GEOs, earned essentially did 80,000 gold equivalent ounces. That was down from the same period last year. Record revenues from royalties and streams, you can see there, and record cash flow from operations came in at 159.9 million, up from 138.4 million. Net earnings were up to a gain of 9 cents per share from a loss in the same period last year. And adjusted earnings came at 52 cents per share from about 40 cents in 2023. And it made net repayments of about 49.7 million under its revolving credit facility. Let's look at the balance sheet here. Cash of around 59.1 million and debt of 93.9 million as at December 31st, 2024. Is a pretty decent balance sheet. Solid access to credit of up to 615 million with only 135 million drawn. Let's look at the growth outlook from this company. Osisko provided 2025 guidance of 80 to 88,000 GEOs with a cash margin of approximately 97%. The updated 5-year outlook through 2029 reflects a reduced delivery compared to prior projections due to the absence of its Eagle Mine contributions. Growth will instead be fueled by expansion at Dalgaranga, Windfall, Hermosa, and Marimaca. That's how I believe we pronounce that. Management highlighted the back half weighting of 2025 geo deliveries, with approximately 55 expected in Q3 and Q4. The company also remarked in its conference call that the slope of the delivery of gold equivalent growth in 2025 is expected to be less steep than previously anticipated due to adjustments at key assets such as its Canadian Malartic and Mantos Blancos streams. Now, we can look at, here's a graph of the growth over the course of the year. We can see here, or the next 5 to 10 years plus. We can see here the guidance for the next year, the outlook for 2029, and the near-term and long-term expansion opportunities for Osisko. Let's quickly look at the valuations here. 2024 price to cash flow is 22.8. The 2025 expected price to cash flow is about 21.3 times. And the adjusted PE based on what they expect in adjusted earnings for 2025 is about 27.48. Put that next to a peer, although larger and a higher quality business. Franco-Nevada trades at about 43.42 times this year's expected adjusted earnings. I would say it trades, you could say that Osisko trades at a discount, but I would consider Franco-Nevada to be a higher quality, larger business that is delivered consistently over time. So there is a reason for its premium valuation. Now, conclusion here quickly. In the royalty / streaming space, Osisko trades well below what we call the big three companies. Its current it trades at about 1.5 times net asset value, despite having a high quality North American centric asset base. Solid optionality in the company's development stage assets. There's also high quality of its flagship assets, and those would be the Canadian Malartic and Mantos Blancos royalty streams they have. Now, given, however, the average growth that we see here, valuations that currently look fair. For us, we have in our coverage, because we always put this company against, or any company that we're looking at against other companies that we can gain exposure to gold, for example. We have higher leverage and less risk exposure to gold at better prices in coverage currently than Osisko. So we continue to monitor this company. All right, that finishes off my presentation on that. Any comments, gentlemen?
I mean, it's such a hefty valuation in that space, right? Even at 22 times cash flow, that's definitely not cheap. But then you look at peers like Franklin up in the 40s times cash flow. Obviously, a big premium for that space, getting the exposure to gold. But you also said as well, Osisko underperformed gold.
Yeah, I mean, it underperformed last year, outperformed 5 years. But if you go back all time, it's significantly underperformed over the past, say, 11 years where gold was. So you should be getting leverage to the price of gold in an asset like this. And if it doesn't outperform over a 10, 11-year period, there are some definite concerns there for me. And its dividend, it's not like you're paying a massive dividend. It's under 1% right now. So, even if we factor in the dividend, it's not close to outperforming gold over the last 10, 11 years. So yeah, you want it to outperform. And the thing is, like, for example, like we have a company that's given a lower risk exposure to gold, like a low risk. I mean, streamers and royalties are relatively lower risk. They can spend their way into bankruptcy. I've seen it happen before, but yeah, we've had a company that's gone up 250% over the past 5 years, which has crushed both of those companies. Plus, it's paid a far higher dividend. So there are other ways to gain exposure to gold. And we had a company that drills for these companies that went up 95% over the past year. So again, gold was up 40-something%. This company up 39%. But that company crushes both those companies. So there are other ways to gain exposure to gold that isn't just buying a gold miner that has all the gold mine risk, the price risk, and yet you gain better exposure with less risk. And I would, the driller we bought last year, and the other company is a miller, driller / and miller. So they rhyme. So that makes them good. No, but anyways, they're good companies, good exposure to gold, and a different way of doing it than most people do.
Yeah, I wonder as well, just like, for demand or their, potential pipeline of streams. Like, I wonder, if it is increasing just with the tougher financing market that we're seeing out there for juniors. Again, I don't really know exactly, are these a lot of, pre-mine developed plans that they're, getting these royalties with? Yes, it is. Yeah. So I wonder,
sorry, I meant I was agreeing with you that there may be an opportunity.
Yeah,
the only thing, I think that high quality, like a lot of the juniors that aren't getting funded, I think we talked about this last week. I did a little soapbox, right? I think those are the real exploration companies that are far a ways away. I think if you had an actual project that you'd proven out, I think you can get funded right now. Maybe there is more competitive markets, right? So a royalty company is in a better position. But yeah, I mean, it is a good thought that, they could be in a better position. We've looked at like Sandstorm recently and a couple of the others, Royal Gold and Franco Nevada. So there's some interest there, but they are certainly trading at premium valuations. And, it's hard to pay up when we do have other options. That's what I was trying to get into. There are other options that gain exposure to gold, have been outperforming even the streamers and the gold miners consistently with less risk. That's what we're opting for right now. All right. We might as well move through the show. I think Aaron has a segment, a viewer question on AMD.
All right, great. Happy to do this. AMD Advanced Micro Devices. So we did get a question from one of our viewers on this company just asking for a general assessment. And AMD is a company that I've actually been looking at recently. It's in the semiconductor space, specifically a CPU, GPU manufacturer. So a lot of hype in that space right now with AI and data centers. But really what I want to do is I want to compare this company to what we would consider to be its closest comparable and competitor, and that would be NVIDIA. So and AMD, leading semiconductor company, as I said, specializing in GPUs, CPUs, trades at about $109 right now, and it has a market cap of $177 billion. So if we look at the company's stock price over the last year, we can see that it's actually down about 38%. So pretty poor performance, especially considering that technology companies, particularly a lot of companies in the chip space, like NVIDIA, have performed very well. So when we compare this to NVIDIA's performance, they're up about 68% for the year. Quite a stark contrast. So what is the difference here? We have two companies in a comparable space generating at least revenue growth and earnings growth from some of the same trends, but certainly very different paths in the market. So why don't we just start with a comparison of these two companies side by side, some of the basic information. So AMD, as I said, a market cap of $177 billion. Compare that to almost $3.3 trillion for NVIDIA. So what's that? Roughly about 20 times the size. So massive size difference between these two companies. Now, when we look at revenue, $26 billion over the last 12 months for AMD compared to about $113 billion. Profit margin wise, NVIDIA is much more profitable at 75% gross profit margins compared to AMD of 49%. And then in terms of bottom line profitability, AMD reported non-GAAP earnings of about $5 billion over the last year compared to $71 billion for NVIDIA. In terms of growth, just looking at the two companies' most recent quarters, we did see very strong growth from AMD, 24% revenue growth, 42% growth in non-GAAP earnings per share. But this was still somewhat dwarfed by NVIDIA, which more than doubled that, more than tripled it for revenue, 94% growth, and more than doubled it for earnings per share at about 103%. Then in terms of analyst estimates, when we're looking forward, so for the current year, 2025, analysts are expecting significant outperformance to continue for NVIDIA, 186% growth at the midpoint of adjusted EPS compared to last year, compared to 43% growth for AMD. Now, when we look to next year, 2026, analysts are expecting this growth spread to narrow. 50% earnings growth for NVIDIA in 2026 compared to 34% for AMD. But then, of course, there's really so many more uncertainties as we project further out. So it's really difficult to know what is going to be happening in the economy, or specifically in the semiconductor and chip space, more than a year from now, 1 or 2 years from now. And now we'll look at valuations. So we're just going to look at valuations based on the midpoint of analyst estimates, about 37 times for AMD compared to 45 times for NVIDIA. So NVIDIA certainly more expensive on a valuation basis, but not that much more expensive, especially considering the fact that the company has generated far more impressive growth and has significantly higher profit margins. Also, being such a larger company is more diversified with much more significant revenue. But you know what? 37 times, given the growth that AMD is expected to achieve, and also considering the fact that it is one of the main leaders, or one of the main companies within that attractive fabless chip market that is in many ways serving the AI and data center space. Looking at the valuation, it doesn't actually look that bad. 37 times for a company that is producing such a significant level of growth. But where I really caution on AMD, and this is where I took a pause on the company as well, is how the company has fared versus NVIDIA within the AI and data center space. So if we look at just the market share for discrete GPUs, so this is what is driving a lot of growth. The GPUs, that's the hardware that essentially powers a lot of this AI technology, and the data centers, which in turn power AI and cloud computing. But we can take a look at the market share differential from 2010 to 2024. So if we go back all the way to 2010, the market shares for discrete GPUs, they're actually fairly similar, 55, 45, NVIDIA, AMD. But this is back when GPUs were primarily used for gaming. It was really around that 2014, 2015 space where AI started to, and cloud computing as well, started to be more of a factor utilizing some of these GPUs. And over this period of time, we can see NVIDIA consistently gaining ground at AMD's expense. So now we fast forward here to 2024, and NVIDIA has essentially completely dominated the market, growing their market share to 90% of the discrete GPU market. Again, this is where we're seeing a lot of the real attractive growth and demand, and they've been able to do this just with technology superiority. So I know AMD is coming out with some new tech that they're hoping will be more competitive, but of course NVIDIA is also doing the same. So this is a concern. Now, in terms of our take, we think that both companies, they have a presence in an attractive market. They're both benefiting from strong growth, but obviously NVIDIA is the dominant company in this space. And that is really apparent in terms of those market share trends. So, really when we look at the valuation, even though on a nominal basis, NVIDIA is more expensive at 45 times earnings, when we factor in the growth, when we factor in the leadership and those market share trends, I really actually think that NVIDIA is more attractive on a valuation basis than AMD. There's just a lot of uncertainties with AMD in terms of are those trends going to continue? And if they do, they may be benefiting right now just from strong growth in the overall market. But if that growth in the GPU market slows down or even reverses for a period of time, that's where it's really going to bite them extremely hard. And they would have more downside potentially than even NVIDIA in that scenario. So right now, we're not recommending any of these companies specifically in terms of recommendations. But I would actually, if I had to choose between the two, I would be more prone at this point to go with NVIDIA over AMD.
The interesting thing about AMD is they've been making more progress on the CPU side. So your AI solutions, they're effectively, you'll have whatever, I think it's like 8 GPUs to 1 CPU, or you have a double CPU socket. And they've been making headway on the CPU side, but that's in comparison, a very small portion of the dollar spent for your data center computing. And that's where they've been making more headway, and that's competing against Intel and not NVIDIA and they're making headway there on the server space. And then on the desktop side, they have been as well over now 6-7 years. But that's the thing is, NVIDIA just has such a really just dominant grasp just in the, not just the hardware side, but also then the software which it applies to, which these large server users, they need a reliable software. And that's where NVIDIA has even come through as well. And it's just been that top to bottom. They've just dominated so consistently over the past, especially the past few years. They, like Aaron was saying, for the last decade or so, they had the crypto space as well. They were dominant there. They've had anything with cloud computing dominated there. AMD just hasn't been able to compete it either on the high end for consumer side or server side now. As it kind of goes server side, you have your data centers GPUs, then below that you have your top tier, you have your workspace, high performance computer, like workspace computer type of thing, and then you have your gaming GPUs below there, and so on. And there's obviously overlap to a degree, but there's a big divide between server and desktop. And they just haven't been able to compete out even now the top end of consumer. They've been pulling back there now over for their next generation, or their last generation now. And it's just really that technological difference between the two. Even though NVIDIA has moved up their price again and again for both server and desktop, AMD just can't really compete just due to the absolute dominance of NVIDIA at this time, for the technology at least.
Yeah. I don't know if you guys saw over the past weekend, TD released some research on like some channel checks that they were doing on just server and demand for Microsoft, essentially, and for data centers. And they had noted that they believe that Microsoft is actually pulling back in data center spending. I mean, it's still high, but it had been pulling back. So, I mean, it's just a note, something to watch for. Is that an influence from DeepSeek? And, is that saying maybe we don't have to, maybe there's an overbuild? Maybe, I mean, we've seen that so many times in so many sectors where everybody gets excited about something and there's an overbuild. Maybe it isn't. Maybe it isn't. Maybe they still have to continue to build. I mean, I'm not going to try to put these two sectors together. And I think there's a lot of smarter people involved in one of them. But the cannabis sector, there's just, everybody got excited. There was a massive overbuild there. Right. And get ahead of yourselves. And I'm not saying that's happening in AI or data centers, but they were checking, at least in the near term. And I do wonder if, maybe the spend pulls back in the near term. Maybe it's just cautionary. Right.
I think there's always a tendency to overbuild, like especially when the theme is a real theme. Right. I mean, you could go back to like the big railroad boom, right? When railroads were being built across America, like that was a big boom at the time. It created a massive amount of wealth and efficiencies, and it eventually turned into a bubble with like a massive overbuild of railroads because everybody just got so excited about it. And it's like, we really needed the railroads, but it doesn't mean you need to build it. You need to build more than what we need, right? And then we see that, every single time it seems that there's
and a bubble doesn't have to be in, like you said, it can be still in something you need. I mean, people are still smoking cannabis everywhere. Brennan's just, I'm just kidding.
I mean, look at the internet. Look at the internet.
Yeah, I know.
Right? Like, obviously the internet, it was a real theme. It was some real technology. It did change the world as promised. That didn't mean that companies should be, given an infinite.
And AI is a real theme. It is a real massive sea change. But do we probably overbuild for a while? Probably.
I would imagine, I would say almost guaranteed, right? The question is, are we at that point now, or does that point come in 5 years?
Are we in the ninth inning near term, or are we in the first inning? We shall see. But anyways, TD did some work and they were channel checking on Microsoft, on their spend, and they were seeing a pullback. Is that for 2 months? I
think they were. They canceled some leases.
Canceled.
Saw that. I haven't gone deep into it. So Microsoft is guiding for an $80 billion spend on AI investments this year, which is actually quite a big increase from last year. So I don't know if analysts are implying that they're going to reduce, or maybe they signed too many deals and they need to kind of pull back. Or maybe they don't spend the $80 billion. I mean, you can guide that and then change your mind as well, right?
I will say Microsoft did restate that they are on track to still hit their 80 billion spending. They did release a
Yeah. Okay, definitely something we'll watch. All right, we're going to move forward in our Your Stock, Our Take. Brennan has a segment on Well Health, a company that he and we have talked about a number of times on the podcast before. We've interviewed management as well.
Yes, sir. So yeah, Well Health, this actually comes in from a client, Gord. I've actually got a phone call with him tomorrow, so you'll be able to watch this while we're on the phone probably as well. So yeah, Well Health Technologies, WELL on the TSX, currently trading at a price of $6.15, $1.5 billion market cap. They don't pay a dividend. And the company provides omni-channel healthcare services, including primary care and allied health clinic operations. The company also operates an electronic medical records platform, billing and revenue cycle management solutions, and cybersecurity protection and patient data privacy solutions. And as of the last quarter, 94% of total revenue was from patient services revenue, while 6% was from software as a service. So just a little history to catch viewers up to speed on Well. We have covered the stock on the podcast several times, including back in 2021 when it traded at $7.50 per share. Since then, we have seen the stock pull back to about $2.56 in late 2025, but it had a strong 2023, which we then covered it again on the podcast in February of 2024. And at that time, I basically concluded that revenue growth was quite strong given its aggressive cadence of acquisitions funded through debt and equity. And, I said, if the company can begin to achieve consistent accounting and adjusted profitability and use internally generated cash flow to bolster growth and pay down debt, there could potentially be an inflection point in the business. But I said that is yet to be determined. Now, today, the stock trades just above $6. And let's look at what's been driving the stock higher and if that inflection point is starting to transpire. So just a quick couple of recent updates here. On February 19th, Well provided updates on 2 acquisitions completed by its subsidiary WellStar, including MicroQuest and Bluebird IT, with WellStar's CEO commenting, as WellStar scales its operations and prepares to be spun out of Well as a separate public company that will be majority owned and controlled by Well, we are delighted to announce the recent addition of MicroQuest, a leading EMR solution provider, and 51% ownership of Bluebird IT, which supports over 700 clinics and hospitals across Canada. And this is really on the heels of its news release on December 12th of 2024, where they rebranded Well Provider Solutions as WellStar, subsequently indicating that WellStar closed on a $50.4 million equity placement, which is expected to fund the company's pre-spin-out growth objectives, with WellStar's pro forma revenue expected to be over $70 million in 2025, with EBITDA margins of approximately 20%. And the pre-financing enterprise value for WellStar is approximately $285 million, with Well expecting to spin out WellStar before the end of 2025 and will provide investors exposure to a pure play investment in healthcare technology software as a solution. Now, a few more updates here. On December 2nd, 2024, Well announced that it completed the acquisition of the Canadian clinical assets from Jack Nathan Medical Corp, including a network of 13 owned and operated clinics, which generated revenue of over $9 million in the past 12 months, and about 59 licensee clinics that generate approximately $2.2 million in high margin revenue. And as a part of the deal, Well has also entered various agreements with Walmart Canada that provide a framework to support the potential expansion of Well's clinical network within Walmart Canada's footprint of over 400 locations over time. And I've actually covered Jack Nathan on the podcast before. It trades under the ticker symbol JNH on the TSX Venture, but it has really struggled to generate any operating profit over the years. It's always reported an operating loss, which likely makes sense why it is selling its Canadian clinics. And on November 7th, the company raised its annual revenue guidance, which I will go into further later in my presentation here. So Well's revenue growth has been very strong, driven by acquisitions and organic growth. The most recent financial results were for Q3 of 2024, ended September 30th of 2024. Revenue was up to $252 million, an increase of 23%. Patient services revenue was about 94% of total revenue, while SaaS and technology services was 6% of total revenue in the quarter. And the growth was from, management says, 23% organic growth, but there was about 4% growth from acquisitions, but this was offset by some divestments as well. And the company's accounting earnings were negative in the quarter, primarily due to a change in the fair value of investments, which were a loss of $77 million, which, if we adjust out, the company produced a gain of about $1.3 million, or about half a cent. This compares to a loss of about 3 cents for the same period last year. So just keep in mind here going forward, all of the adjusted EPS figures I highlight are my own calculations. I'm not using the company's reported adjusted EPS. Now, I'll also note that the strong net income reported in Q2 2024 should also be adjusted to the downside, meaning the 43-cent per share is inflated, as again, there was a fair value adjustment, but this time it was a gain of about $116 million, which if we adjust out, they actually only did about $649,000 in net income, or about 0.003 cents per share in the quarter. In Q1, again, same thing. There was some changes here in fair value and a disposal of assets, which they actually lost about 2 cents per share. And the same can be said for Q4 of 2023, where they lost about 3 cents per share rather than a gain of 12 cents per share. So I just wanted to go over that just to make sure that we're kind of like looking at the same numbers here. Now, adjusted EBITDA in the quarter was up about 16% to $32.7 million. And looking at the balance sheet as of September 30th, 2024, Well had $66 million in cash, and debt and leases were $396 million, providing a net debt and lease position of approximately $330 million and a net debt to EBITDA multiple of about 2.7 times, which compares to a year ago of net debt of about $359 million and a net debt to EBITDA multiple of 3.3 times. So debt, is coming down, but it's still very elevated. And quickly looking at the valuations, the company has a negative trailing adjusted earnings, which I had calculated there. So we don't have a multiple there. Its enterprise value to EBITDA multiple is approximately 15 times and trades at about 12 times trailing cash flow. Looking at the company's fiscal year 2024 guidance, annual revenue is projected to be $985 to $995 million, which is 27% growth over 2023. Adjusted EBITDA is projected to be in the upper half of its $125 to $130 million range, which would be 12% growth over 2023. And adjusted free cash flow is expected to be $55 million for the year. So if we use these forward guidance figures, we're looking at a price to free cash flow multiple of about 27 times and a forward enterprise value to EBITDA multiple of about 14 times. And I keep referencing this every time I cover the Well on the podcast. But again, the reason for the company's ability to continue to make acquisitions on top of its hefty debt load is that the company continues to issue shares quite aggressively, as shown in the chart in my slideshow, with the company now up to 250 million shares outstanding. And I must remind our listeners that an acquisition growth strategy funded through issuing shares can be successful, but it is a much harder path to growing cash flow per share or earnings per share than simply recycling excess cash flow into acquisitions. So to finally conclude here, Well continues to show great revenue growth over the past few years, with revenue of just $32.8 million in 2019, now guiding to over $980 million for fiscal year 2024. The company's astonishing growth has been driven by acquisitions funded through share issuances and debt. It's good to see that the company is producing cash flow, which will help the company pay down its debt, which, like I said, is on the high side currently, with a net debt to EBITDA multiple of about 2.7 times. And hopefully this cash flow begins to reduce its reliance on issuing shares. The company is planning to spin off Wellstar in late 2025, which is expected to be worth a pre-financing enterprise value of about $285 million, and produces revenue of $70 million and EBITDA margins of above 20%. And Well will remain the majority owner of Wellstar. The forward valuation multiples of 27 times free cash flow and about 14 times adjusted EBITDA are not cheap, in my opinion, especially when we consider the balance sheet. But all in all, the company still has work to further progress into consistent accounting earnings, more significant free cash flow, reduce its debt load, and reduce its cadence of issuing shares. I love that the company is guiding towards positive free cash flow in the year, but I'm not confident enough to say that the business is at an inflection point, especially if they want to maintain their aggressive cadence of acquisitions. I think that the direction of the business is trending positively, and there may be some speculative upside, despite the stock being pricey on a valuation basis. But, I personally would not invest in the company at this time, given its elevated debt load and heightened share count. It's certainly a name we will continue to follow closely, though, especially as, hopefully that free cash flow continues to grow going forward here. And just a disclosure here, no one at Keystone owns the company.
Yeah, I mean, I think it's a pretty solid Canadian success story, but yeah, I mean, the debt and the lack of free cash flow, really, like the multiple, even on a forward-looking basis, is high. With there's not a lot of organic growth in the business, really. You didn't see any breakout, really.
There was like decent in the last quarter, but like as I've looked at it in the past, a lot of the times
historically
they haven't even broken it out.
Yeah.
I would say exactly, most of the growth is from acquisitions. Exactly.
Yeah. And it's stellar growth from acquisitions, but you saw the share count moving higher, and producing meaningful actual EPS is not there right now. And, on an adjusted basis, it looks decent, but you have to basically keep making acquisitions. So you're fighting against diluting or adding more debt. And, it is, if it was far cheaper, maybe there would be a case to be made here. But I mean, we find companies that trade at lower valuations with more organic growth. And again, that's what we always say. This is better than like 80% of companies on the TSX, or maybe 90%. But we're looking for the top 1 or 2%, really. And does this fit that criteria? Probably not at this point. Certainly not a terrible company.
No. And just to compare it to, like, there was another company again in like the fall of 2023 we recommended, which was like a healthcare, SaaS kind of play. And they were trading at, significantly lower. Like I think it was like
we brought them below 10 times free cash flow with net cash, not net debt.
Exactly.
And organic growth of like 15% plus. So
exactly.
That's what we put them against. Now they're not in the same business exactly, but they are in healthcare. They're servicing healthcare, and and that's what we were able to buy. It's a great example of, ranking companies against each other in the overall market, and what is your opportunity cost for putting your money in this company versus, another company. Yeah. And then that's what we were able to do at that time. And as an aside, I do remember Jack Nathan. We got questions on that company as the stock surged, above $1.50. I think it's gone to 2 cents now, or 2.5 cents. Right. And we said, this makes no sense on several podcasts, and the business didn't. There wasn't a profit there. There wasn't what we look for in a business. And, it's not, I told you so, but it's just look at the stock price over the past several years. And Jack Nathan looks like it's not going to be around very soon. So,
exactly.
All right. Let's finally move. Or has anybody else got anything on that? Am I cutting anyone, or we're good? Let's move to our star and dog segment of the week. Brett is going to handle.
Yeah. So our star of the week is Celcius Holdings, symbol CELH on the NASDAQ. It is a global beverage company and maker of the energy drink Celcius, a zero sugar alternative to traditional energy drinks. Celcius is the number 3 energy drink in the US, with about 11.8% market share in 2024. The share price just shot up last Friday, trading upwards of 35% higher during the day. It ended up settling a bit lower at only a tiny 30% gain for one day. That's not very much, but still 30% amazing. The stock is now trading at about $32.13 a share and a $7.5 billion market cap. So why did Celcius shoot up on Friday? Well, it recorded it. We'll take a look at its Q4 2024 earnings, but nothing really astounding happened in it. So For the year, 3% revenue growth up to $1.36 billion. Retail sales did grow by 22%, with the difference being really made up of PepsiCo optimizing their distribution to lower the inventory held on their hands. But this does mean lower sales recognized for Celcius during this period, despite retail sales growth growing at a higher rate. Gross profit increased by 7% to $680 million at a 50.2% margin. Marketing rose to 25.9% of revenue from 20% as the company had additional marketing activity during the year. G&A rose to 12.8% of revenue from 7.8% due to litigation costs, as well as some one-time costs, resulting in an overall decline in net income of 36% to 145%. Overall, not below a quarter. Frankly, not even that great of a quarter by any means. So why did it rise so dramatically? Celcius announced the acquisition of Alani Nu for $1.8 billion in cash and stock. Just for a size comparison, Celcius at the time was trading at roughly about a $5 billion market cap before its acquisition. So a significant acquisition just by the size of it. The company paid less than 3 times 2024 sales, or approximately 12 times adjusted EBITDA. The company prior to the acquisition was Celcius, that is, was in a net cash position, but this will put the company actually in a net debt position, but not an overly burdensome one, or about at 1 times EBITDA. Alani Nu, it was the 4th largest energy drink in the US, so just one below Celcius, with a 3.6% market share for 2024. The acquisition is expected to be accretive in cash EPS in 2025, adding additional top-line growth as well, and having $50 million in cost synergies. On the product positioning side, Alani Nu has an interesting target demographic, especially for energy drinks, being young and female-focused compared to Celcius, gender-neutral and fitness enthusiast target. So different target marketing. But on the distribution side, the company sees opportunities to meaningfully grow Alani Nu's distribution by applying Celcius channels and marketing strategies. So different target marketing, but you have these overlapping synergies in distribution and overall strategy for the two companies to come together. So while Celcius is our star of the week, I will mention the stock has been trading quite a bit lower throughout really all the year. Until about last week, it was not performing well, down around 50% in throughout the year, as the earnings just have not been meeting up with the growth expectations, which it was trading very pricey multiples. I think when I first had a Celcius, it was about a year and a half ago at an investor conference in the US. And the boys are shaking their heads right now because I think they had one as well. The one time I think I've seen Ryan had an energy drink and he was shaking. But it was trading at very high multiples at that time and had very, very lofty growth expectations. And we really saw throughout the year that they just weren't able to meet that. But really, I wanted to highlight this as it truly makes it our star of the week, not a star of the year, as it has just had great performance over the last year, but really quite bad performance throughout the past year and great performance over the past week. So star of our week. I don't know if you guys have any comments on that.
I do remember intaking that Celcius beverage. Yeah. No, I mean, honestly, great revenue numbers.
Did you like it though? Like, what did it taste like?
I lie. I hardly even remember. No, I do remember having them there. I remember the packaging and everything. They looked good. No, it tasted similar to other energy drinks I've had.
You're probably not their target market anyway. So.
What are you talking about?
It was like Brett said, like at one of the investor conferences that I had my first one, because again, it was just primarily in the US, then they eventually launched into Canada.
You'll always remember
I am more of a Red Bull guy, even though hopefully my mother Colleen isn't listening to this because she'd be, Brennan, don't drink those bad energy drinks for you. But she will. She'll be saying that. But yeah, I mean, I will literally go to a convenience store and buy a Celcius now. You know, I think that is like the only other, you know, energy drink that I will drink over a Red Bull. I just find like the Rock Stars and the Monsters just like way too sugary personally. They're very, very sweet. I don't find that too much from, you know, Red Bull and Celcius, even though when you look at the back of it, you can see, you know, 100 grams of sugar or whatever it is in each, but they just don't taste as sweet to me, which is why I like them.
Yeah, Celcius does use sugar substitute, so it'll be, I forget which one they use, but they do use it's zero sugar.
Mm-hmm. Yeah. 100 grams of zero sugar.
Exactly.
All right, let's go to our dog of the week.
Yeah, so our dog of the week is TFI International, symbol TFII on the TSX as well as the New York Stock Exchange. It is a North American leader in the transportation and logistics industry. The company operates across Canada, the US, and Mexico, serving less than a truckload, and logistic segments. The stock has fallen 30% over the past week to about $127, or a 10.8 billion market cap Canadian. This is just a sharp decline after really years of consistent share price appreciation. You can see there on the left, quite consistent, very few significant drops really since the pandemic. So this is the biggest, I think, percentage drop since then. I think the last one, it was about a 20% drop in that 2022, if you see there. So what has really changed this week? The company reported its Q4 2024 earnings. For Q4, revenue before fuel surcharge was up 9.1% to $1.83 billion due to acquisitions done in 2024. They're a serial acquirer. Lots of them are tuck-ins and smaller, but they do consistently do acquisitions, and that is why revenue was up. But operating income was down 19.2% to $160 million. Adjusted EBITDA down 1.7% to $315 million. Adjusted net income was down 30.7% to $102 million, or $1.19 per diluted share. Just generally weak earnings, to say the least. It was not a good quarter across the entire metrics. Every single one was effectively down. Even when you're looking at more operational metrics, which I do not have up here at the moment, effectively everyone was disappointing. So what was this reason for this overall weakness? Margins for all the segments were down significantly, with aggregate operating margin down 8.8% from 11.8%. Even though the absolute figures for truckload increased due to acquisitions, margins compressed due to just low volumes. Volumes fell, but shipment weight remained the same. For the US less than a truckload, shipment count actually fell by 6%, which is significant for any shipping company. Notably, the company highlighted weaknesses in the small to medium-sized customers, which tend to have higher margins than the corporate or third-party logistic accounts. So you're losing your high-margin accounts and replacing them with lower-margin accounts and having overall lower volumes. It's not a great scenario. So lower demand has really been seen across the market as well, not just TFI. I'll make that very clear. This is a freight issue as a whole. The market is overall weak. Freight volumes internationally have been weak. It is a cyclical market, and you are seeing both a weaker pricing environment and lower volumes, making it a tough environment for any company in the industry to really operate in. Within the company called out T-Force, though, a company they acquired in 2021, being a significant drag on the company with a poor operating ratio of 97%. Effectively, operating expenses are 97% of the revenue they bring in. The company is trying to make some moves despite the really awful environment to operate in. The company may look to conduct some further acquisitions. The CEO was saying they need to be bold, which it has continuously done over the year. They've done many, many acquisitions, which I have up here. You'll see double-digit acquisition count for the past 5 years. So they are an acquisitive company, to say the least, but they do need to mind their balance sheet. Its debt to EBITDA is 2.1 times. It's not absurdly high, but if you do start to see EBITDA drop, that can get out of control quick if you really do see a very, very weak freight market for extended periods of times. Whether that happens or not, I don't know. And the CEO himself has been repetitively said in the conference call, it's foggy and it's just not a clear marketplace in general as a whole. But the company is looking to reduce debt during 2025 by about $500 million, which may open up some further room for being opportunistic in a down market, which is always good to see when a company does have the balance sheet room and the capacity to be acquisitive and buy companies at cheap prices. That can be great down the line. But it's really very difficult at this time due to the downward trend of the industry. Ryan has previously actually stated in Your Stock Our Take, the company may be interesting on a 10 to 20% pullback, which this would actually be well surpassed that. We're looking at 30% here. But the weakening demand does really require a discount, which is the question, is this enough of a discount now that we're in a really cyclically down market? So I'll echo what the CEO said during the conference call multiple times. The outlook is foggy. So I would expect higher volatility in the stock price over the next year, especially when earnings come out. You're going to probably see very big shifts up or down as this foggy scenario doesn't clear up. And then further, of course, there's things like in the US, even though they don't do many, I think it's under 5% of cross-border shipments. You have the tariff scenario. If the US economy does weaken, what is going to happen there. Obviously, if the U.S. economy does weaken, you have less shipping, you have less any transportation. So will that actually impact the company if we do see a U.S. economy, which has, even in this weakened shipping environment, the U.S. economy has generally remained quite resilient, especially compared to other economies around the world. So that is really what you'll want to be watching for TFI going forward, is can the entire industry start to really pull itself up, and do the market conditions improve as a whole? And as well, then on the TFI side, can they navigate it? Can they make an opportunity out of this really poor environment? Are they able to hit the right acquisitions? Because like I was saying before, their 2021 acquisition of T-Force hasn't gone so great. So you really want to see those companies actually push forward and not just make poor acquisitions, because you can't make bad acquisitions even at cheap prices. But for now, it is our dog of the week.
Yeah, well done. One thing that I would like to mention as well is, like, we ended up interviewing Titanium Transportation Group, TTNM, on the TSX back in like September of last year. So not too long ago. And again, we were kind of getting the same thing from them. Like, they're talking like exactly just what Brett said: weaker pricing environment and demand. And here's a little segment of my notes here. These are just taking notes in that meeting. In 2023, pricing was strong. People were getting money and buying tons of products. And everyone and their neighbor was buying a truck and getting their truck driver's license. They went from having not enough trucks and too many loads to too many trucks and not enough loads. 2024 was really the accumulation of this, and they had so much overcapacity in 2023, but now getting beat up in 2024. There are certainly headwinds given the pricing environment. There is a tailspin in the industry of overcapacity, but the management of this company was saying that they think the tailspin will be over quickly. Who knows? But it really puts it into perspective.
Yeah, and Titanium has been cut in half basically since May, April of last year in terms of its share price. So for me, I'd love to see, Brett was saying, the company pay down some debt. The weak demand would have me revise lower any entry point in this company. I would rather see, we need either a massive discount in this fog that we're seeing here, to quote the CEO. I'd rather wait until we see debt pay downs and a turn in the numbers before considering buying right now.
And that's really,
it's been a good long-term company. It has had a good trajectory, but that is turning, it looks like, in the near term. And with debt higher, share price higher, or share count higher, we want to kind of stay on the sidelines until we see, pay down some debt. And then if we see, potentially more or just better economic activity, like, this is a company that has executed well in the past.
Yeah. And that's the problem with these cyclical companies, is sometimes when they're looking the greatest is the worst time to buy. And when they're looking the worst, is the best time to buy.
Yeah. So if you're going to look at that, find a really good company, like, say, identify that TFII is a great company, and then, buy it when it looks ugliest, potentially. That is not the strategy we use, but it is, something that you could look at if you are looking at a company like that.
Assuming, of course, that ugliness and that risk is reflected in the valuation, because sometimes what see is the financial picture is not great, but the valuation still does not include all of that risk.
That would just be a lot of ugly, too much ugly there. Yeah, you want ugly and the numbers start looking good. Yeah, for sure. All right, that's going to finish off our show for this week. If you are viewing this on YouTube right now, smash that subscribe button. Or if you're listening to this wherever you consume your podcasts, rate and review us. Keep your questions coming into our Your Stock, Our Take segments. And as always, I wish you profitable investing. Thank you.
Thank you.
Thanks, everyone.
Thank you.